There's a theory that the US dollar isn't collapsing by accident, but by design. And it all supposedly starts with one date and one decision at the very top.
All right, today we're jumping right into a pretty wild prediction, a theory about a specific three-step plan to deliberately devalue the US dollar. We're going to break down the argument behind it and then walk through the strategies some folks are suggesting to protect your portfolio. Let's get into it. So the source material we're looking at kicks off with this line. Wow, I mean, that's not some vague warning, is it? That is an exact date. It's designed to make you sit up and pay attention, and it really sets the stage for a pretty high-stakes argument about the future of money. So, you have to ask, how on earth does someone land on such a dramatic, specific prediction? Well, that's exactly what we're going to unpack right now. We're going to go through the logic piece by piece to see the exact chain of events this theory claims is coming. Okay, let's start with the prediction itself. According to this theory, the whole thing doesn't start with some big market crash or a war. Nope, it starts with a simple change of personnel, right at the very top of the US financial system. And here's why that specific date, May 15, 2026, is so important. That's the day Jerome Powell's term as Fed chair is up. The entire argument hinges on his successor, who the source names as Kevin Walsh, coming in and completely changing the Fed's direction to satisfy political pressure. Now, this is where it gets really interesting. The source calls this incoming Fed pick a chameleon. They claim he's done a complete 180 on his entire philosophy, going from a hard money guy who wanted to raise rates to suddenly being a rate cut guy, all supposedly to get that top job at the Fed. So, this brings us to the absolute core of the theory. How could a new Fed chair possibly justify cutting rates? I mean, if you want to juice the economy, but inflation is still running hot, you've got a serious problem. Well, the source argues the solution is simple. You don't change the economy, you just redefine inflation. And here's the exact problem the new chair would have on day one. Official inflation is over 3%. I mean, any economics 101 textbook will tell you you either hold rates steady or you raise them. Cutting rates would be like pouring gasoline on a fire, so you need a whole new playbook. And the proposed solution, the ace up the sleeve according to the source, is this new inflation metric called Trend PCE. Now, it's sold as just a technical upgrade, right? A smoother, less volatile index. But the argument is that its real purpose is just to spit out a much lower inflation number. So, how does this new metric magically create a lower number? Well, this is the key. The source claims the tactic is to simply remove the single biggest, stickiest expense for almost everyone, shelter, so housing and rent, and just take it right out of the calculation entirely. Now, if you think that sounds crazy, the source is quick to point out that this kind of thing has happened before. It gives us a historical example from 1983. Back then, the Bureau of Labor Statistics made a similar technical tweak. They stopped using actual home prices and mortgage payments and switched to this made-up number called owner's equivalent rent. And what happened? The official inflation rate dropped, like overnight, even while real-world housing costs kept going up for everybody. Okay, so if they mess with the official inflation numbers, what does that actually mean for us? This brings us to the biggest risk highlighted in the source material, the threat to what we all consider safe money, especially for savers and people holding things like government bonds. And if you're asking yourself, why would they do this? The source points to this absolutely eye-watering number. The Federal Reserve itself is sitting on over $844 billion in unrealized losses. These are from all the bonds they bought when rates were zero. Now that rates are higher, those bonds are worth way less. So the argument is, the Fed has a huge self-interest in cutting rates to fix its own broken balance sheet. This table just lays out the risk so clearly. Let's walk through it. Say your savings account earns 4%. If the new official inflation number is only 2%, hey, it looks like you're making money, right? You're ahead by 2%. But what if your actual cost of living, the hidden real inflation, is actually 5%? Well, then your purchasing power is silently being destroyed. You're actually losing 1% every single year, and the official numbers are telling you you're winning. So, given this whole scenario of intentional currency debasement, what's the game plan? The source doesn't just drop this big problem on us, it actually lays out a three-step protection plan, sort of a playbook for how to defend your portfolio in this kind of environment. And the strategy is pretty simple, really. It's 2 parts defense and 1 part offense. First, own things whose value can't be changed with a spreadsheet. Second, get out of the investments that rely on the Fed giving you an honest inflation number. And third, get ready to play offense when the market finally wakes up and reprices everything. Let's break down each one. Step 1 is defense. The logic is simple. If the game is all about manipulating digital numbers, then you want to own real, physical stuff that can't be edited. An ounce of gold is an ounce of gold. You can't change that with a new government formula. The source points to hard assets like these, precious metals, industrial metals, as your foundation.
The second defensive move is all about rethinking what you consider safe. The argument is that things like long-term bonds or even just tons of cash sitting in a savings account are really just bets. They're bets on an honest Fed that's going to protect your buying power. But if the Fed starts saying inflation is 2% when your real costs are going up by 5%, well, those safe assets suddenly become guaranteed losers.
And finally, step 3. This is where you go on offense. If the consensus is totally wrong and the Fed pivots to cutting rates like crazy, certain assets could just explode in value. This is especially true for anything that benefits from a weaker dollar and what's called collapsing real yields. That's just when interest rates are way lower than the real rate of inflation. So the source suggests looking at things like silver, which often runs harder than gold in these setups, and other broad commodities priced in dollars.
So we've walked through the prediction, the how, and the three-step plan. But, the real takeaway here isn't about just blindly copying some trades. It's about understanding what signals you need to be watching for, as this whole story either does or doesn't play out.
This quote really just sums up the whole thesis, doesn't it? It's a bet against the crowd. It says the entire market is expecting a slow, careful, data-driven Fed. But the prediction is that a new Fed chair, driven by politics, is about to do the exact opposite and catch everyone completely flat-footed.
And that really leaves us with this final question. Whether you believe this specific prediction or not, it's an incredible thought experiment. Just ask yourself, if the market woke up tomorrow and suddenly believed the Fed was going to start slashing rates way sooner than anyone expects, what in your portfolio wins and what loses? Thinking through that might just be the most valuable takeaway of all.
But the real question isn't if it happens, it's whether your money survives if it does. Subscribe if you want to stay ahead of macro shifts before they hit your portfolio.